diving immediately into an investment case titled 3 Reasons I'm Buying More WULF Stock Today.
Yeah, a really compelling argument for their pivot from crypto to HPC, but we have to talk about the elephant in the room, which hits the reader in the very first sentence.
Exactly. That's our first point. The structure could be improved by dedicating a clear segment to neutralizing the huge Q3 2025 GAAP net loss.
Right, the weakness is just so clear. You introduce this massive negative number, negative $455 million, and it creates immediate friction for the reader.
It does, and then you pivot to the 3 bullish reasons, but that number is still ringing in their head.
That financial anxiety just overrides the whole AI pivot story. GAAP losses like that can be misleading, full of non-cash charges. But if you don't explain that, the reader's already lost.
So the suggestion is to integrate that explanation right into the structure. Don't treat it as an aside. Make it a foundational point, a myth to debunk right at the start.
Yeah, absolutely. Explain how this accounting loss is actually masking the successful capital investment.
You could even frame it explicitly, maybe a segment called The True Cost of Transition.
I love that. And you could immediately contrast that scary negative $455 million GAAP figure with the $18.1 million in Adjusted EBITDA.
Right, showing them that the operational health is actually really strong. It turns a weakness into just a necessary part of the story.
Okay, so once we fix that structural issue, what's next?
We turn to the other pillar of the case, the infrastructure. The infrastructure advantage needs to be more explicitly tied to the pricing power and fixed revenue of the AI pivot.
The material does a great job talking up the physical advantages, the immediate plug-and-play capacity, the 95% zero-carbon energy.
For sure. But the connection between that clean energy and why they get high-margin contracts is just sort of implied.
And that's a competitive moat that needs to be shouted from the rooftops, not just hinted at.
So the suggestion is to strengthen the argument by showing exactly how that ESG advantage translates into tangible contract value. It creates real barriers to entry.
Because this isn't a gimmick, right? The 95% clean energy is a hard requirement for big tech partners.
That's the key. You could show how the zero-carbon mix from nuclear and hydro is non-negotiable for partners like the Google-backed Fluidstack.
Which is what allows WULF to charge a premium for that 510 megawatts of power?
Exactly. Their competitors are stuck in 3 to 5 year grid connection queues. Grounding the high-margin claim in that scarcity makes the case so much stronger.
Okay, that makes sense. Which brings us to the valuation.
Let's talk about it. To make this case truly persuasive, the valuation argument should rely less on external analyst targets and more on a unique, internally derived metric.
Yeah, is there a risk that leaning on that average analyst price target of $21.15 just feels a little passive?
It feels like you're outsourcing the thesis. The author presents all this unique data, but then just points to the consensus at the end.
Right, you want to own the valuation, not just cite it.
Precisely. The suggestion here is to create a proprietary evaluation framework, something that compares WULF to the right peers, not crypto miners, but specialized infrastructure players.
So what would that look like in practice?
Well, for example, you could calculate a price to MW deployed metric, a P per MW.
And compare that metric directly to other specialized data center operators, that would capture the scarcity value of their existing power infrastructure.
Or you could use that sharp 25% quarter-over-quarter Adjusted EBITDA increase to project forward cash flow.
And build your own personalized price target from that. That would be much more powerful.
So that really wraps up our critique. To maximize the impact here, first, you've got to structurally address that GAAP loss head-on. Reframe it.
Second, tighten that link between the zero-carbon infrastructure and their actual pricing power on contracts.
And third, build an original, internally derived valuation thesis. Use a metric like price to megawatt.
Make those revisions, and you take a really good case and make it exceptional. We look forward to seeing the update.